Morning. It's Shooter. It's about 5 a.m. Actually, I woke up about 30 minutes ago and I was thinking about risk. I think some of my best thoughts come when I'm like half asleep and I've got that one eye open and I'm like thinking about, what I did in a particular trade. So I wanted to spend a minute and just go through what I do to manage my risk. And there's a number of premises that I think build on that. So let me just jump into that thought. This is probably at least controversial, but uncertain events with uncertain effect. And I think we have some uncertainty between limited choices. We don't have the strike we want. We can't get the date we want. To a certain extent, that's organized. That's somebody like me who's sitting back in a room and saying, okay, I'm only going to sell 57 calls because there's no way that's going to happen. I'm not going to sell the 55 call because there's too much of a risk that they're actually going to be put to me. The actual outcome is uncertain. So I think when we look at a trade, there's constant uncertainty in what that outcome is. So to me, I look at it as everything is a risk of loss. So how do I identify that uncertainty so I know when I'm wrong? The volatility of our own assumptions. And I'm wrong a lot. I'm just good at risk management. So when I'm wrong, I've learned when to get out so I can recover, because I'll take a hit and, you'll notice that I changed my mind. That's one of the difficulties, I think, with trading options, is that you have to change your mind. Sometimes as often as you like something, you're going to flip 5 seconds later as soon as something changes. So the volatility of those assumptions is a huge factor in, I think, how we set up our risk. Thank God for the internet. We can find just about anything we want to help us with the images in our mind to evaluate things. So, I think the first thing is that we need to look at this like a pyramid. And so, I look at risk and I have risk laid out in really a multiple of levels. And the levels are based, first of all, me as a whole, as a trader, and then the different vehicles that I have are each have their own compartment. I like to call them boxes. So options has one type of risk. Cryptos has another type of risk. Bonds have another type of risk because they all have different outliers that may or may not affect that type of trade. So let's jump into the nuts and bolts here, and let's identify the process that we should use to lay out our stops or our risk management tools. Sometimes my best thoughts are when I'm half asleep or when I just wake up, bam, like I did this morning at 4:30. And I was thinking about risk management. And I don't know what news I heard, but it was something about the Ukraine willing to negotiate with Putin. And I'm like, man, we're going to ramp. And I started thinking about all the trades that we were in. And I was like, so I want to devise a process to try and help you folks manage your risk. So my first thought here is, so I think using support and resistance and levels to manage your risk is probably the easiest way for somebody who's a novice. So my assumption is you're a novice, not a pro. So no offense meant by that. It's just, all right. So in looking at Elliott wave, managing from we have these channels that we see based on our wave degrees. So we have, cycle waves, which are the blue ones that I just posted. Then we have primary waves, which are the green ones that I posted. Then we have intermediate waves, which I'm drawing here, all right, et cetera, et cetera. So jumping back to the base model, and I'm using ARC because this was one of the stocks that I first thought about with this ramp, because I'm like, okay, I really did not know where my levels were. So in an uptrend or a downtrend, we have these breakout lines in an uptrend. All right, so we're potentially getting a breakout. So we take our prior high and we're looking for a new high. When we back test that, that's considered a confirmation. And at the same time, we also have a breakdown of that same zone that we would have down here. So that zone is not broken as an uptrend until we close below that 33. We have resistance and support that's established for that zone. So is my support line based on the Elliott wave count. That is our support and resistance bands. We have these levels that occur based on our wave degrees. I'm saying based on our wave degrees because that, as far as I'm concerned, is our only support and resistance line. Because the rest of it really doesn't matter if you're trading from a cycle basis and using Elliott wave, because everything else is noise. Until we hit a 5-wave up, we don't, that's not important. The rest of this price was what we needed to get to that wave 5, to get to that 160. So at the wave intersections, this is an intersection, is where we want to look at our support and resistance from setting it up. So we have 2, 3. So our resistance line, and this is how I would suggest that you set up your levels for the purposes of looking at an entry or an exit. Same case here. The only level that really matters here is this 132 on the breakdown because it's an ABC down. So this is our breakout line. And this is our breakdown line. So you guys understand how to set your levels and use support and resistance, okay, to determine your risk. All right, so this wave 5, so just like these are our levels, ABC down. Now we have this 5 wave. Now we have some internal levels that we could look at. So we have our 3, 4, 5. So, and the difficulty is there's also going to be some heat that you're going to take based on what you decide are the levels you're going to use for your risk management. So correspondingly, based on your wave degrees and the time frame that you're reviewing, there may be multiple levels that you're looking at here. So from a risk management on the way up until we close below the breakout line, right, I'm in it. So then I'm going to reassess, and my next stop is, okay, we got up to our count, depending on what wave degree you're trading. One reason I stay in the intermediate wave and the minor wave categories is because price I know. Okay, in the shorter time frames, I can really predict price and be fairly accurate. The further I go out in time, the more deviations I have. So it's where I stay in that little zone because I have a lot of conviction. So we had this 8% move in ARK yesterday. Now, I happened to make the comment in the room that I didn't expect it to do anything for the next 2 weeks. And I suggested that, hey, I'd switch and sell calls because I was thinking it would continue. Now with yesterday's ramp, the count's changed. So ultimately, how do I assess my risk to stay in there, use my levels here to stay in or out of this particular trade? So I'm going to come in here and I'm going to add a secondary set of lines down here because we have and I'm just coming down here from a micro standpoint because I really don't want to take this heat up to $109 from 65 in calls. So I'm looking at this, where am I right? Where am I wrong? So that would be my, and I'm just leaving these lines the length they are because it's easier for that purposes. So look at my prior breakdown. I'm coming here and speed line, right? So close below the breakdown. It's a reason for me to close the trade, right? Close below the breakdown, right? Reason me to leave the trade. So as I'm leveling up and the trade is working, I'm looking at different levels. So we're up and above. As long as we don't get closed below this breakdown, right? I'm still long, right? Same thing. As long as I don't close above the breakout, I'm still short, right? Now, the reality is you can lose your ghost there quite quickly in the wrong direction. So close above, right? Now, in this situation, I can see that I have a 5-wave potentially going up to 86. This wick coming up until we close below support and resistance band, right? I'm not interested in continuing to carry anything short on this arc at this point, right? Reason is the wick closed above the breakdown line as far as I'm concerned. So we did not get a back test like we got here. Did not get a back test like we got here. Did not get a back test like we had here. Okay, so we didn't get here in this situation up. We had higher low, higher low, higher low, higher low, higher low, higher high, higher high, higher high. Okay, lower low, lower low, lower low, lower low. Now we could wait until we get up to 80 bucks, but honestly, the way the count has shifted and sentiment towards maybe a resolution in the Ukraine, you know, I would suggest that there's a chance that we rally here. Now, right now, as I'm looking at this at 6:07 in the morning, you know, right now we're sort of neutral to flat to maybe a little red. So it's obviously it's your risk management, but you know, when I look at each individual trade, I wanted to devise a way where I could express what my thoughts are when I'm setting my stops. So ultimately, once this 68.27 prints, right, my exit now is the retrace. So realize once that 68.27 prints, so right now I would not close. My exit would be back around 61 for those calls. All right. And that should be a safe exit. Now, could we ramp and just blow past that? Yes. So where do I close no matter what? I'm closing no matter what at the next step up. So I'm looking at 72.65. So we ramp up to that 72.65, I'm out. Okay. Otherwise, I would wait for this to manifest, wait for the back test, and then exit. One great thing about Elliott Wave is it gives you good entries, but it also gives you excellent exits. So you can get a visual of where you might get out. Well, until next time, folks, great trading.